Something extraordinary is happening in the digital asset space. While Bitcoin's price undergoes a violent breakdown and altcoins suffer a literal bloodbath, a strange piece of historical lore has resurfaced to define the current mood. Michael Saylor, the face of institutional Bitcoin, has appeared in the Epstein files. But before the headlines could pivot to scandal, the truth emerged. This isn't a story of corruption, but of a man so singular in his focus that he was deemed unblackmailable. In an internal email from 2010, long before Saylor discovered Bitcoin, publicist Peggy Siegel lamented to Jeffrey Epstein that Saylor was unusable. She described a tech billionaire with no ego, no vanity, no sex bait, and no social instincts. Siegel famously wrote that she didn't even know how to blackmail him because he simply doesn't respond to normal human buttons. In 2026, as the market panics, this story has shifted from an insult to a badge of honor for the Saylor-tracked investment strategy. It paints a picture of the man holding the world's largest corporate Bitcoin treasury as a zombie for logic, a character trait that saved him from a dark social web and one that currently keeps him from selling his billions in BTC, even as the price touches his cost basis for the first time in years. While the Saylor law provides a psychological backdrop, it is not the reason for the crash. To understand why your portfolio is bleeding, you have to look at the plumbing of the global financial system. According to macro analyst Arthur Hayes, we are witnessing a staggering $300 billion liquidity drain. The primary culprit is the Treasury General Account, TGA. Think of the TGA as the US government's checking account at the Federal Reserve. When the government spends money into the economy, the TGA balance drops, and liquidity, the oxygen of the markets, increases. However, over the last few weeks, we've seen a $200 billion spike in the TGA. The government is hoarding cash, pulling it out of the private sector and the banking system to prepare for a looming political storm. Bitcoin is the most liquidity-sensitive asset in the world. When the TGA rises, Bitcoin falls. Historically, Bitcoin found its legs in mid-2025 when the government was draining this account. Now, that trend has reversed with a vengeance. We are in a liquidity desert, and without the flow of dollars, the speculative fire of the altcoin market is being extinguished. The macro pressure is already claiming victims in the traditional world. Breaking news has confirmed that Metropolitan Capital Bank and Trust has become the first US bank failure of 2026. This isn't an isolated incident. It is a direct symptom of the global liquidity crunch. Simultaneously, the United States government has entered a partial shutdown. The Department of Homeland Security and ICE have lost their funding as the House and Senate remain deadlocked. The political rift between Speaker Mike Johnson and Hakeem Jeffries has reached a breaking point. Jeffries' refusal to provide Democratic support for the funding bill means the GOP must find total internal consensus, a feat that seems impossible given the current factionalism. In past cycles, a banking crisis or a government shutdown served as a bullish catalyst for Bitcoin as people fled to hard money. But in 2026, the scarcity of dollars is so acute that investors are forced to sell their winners, Bitcoin, to cover their losses elsewhere. There is a coordinated legislative attack currently unfolding. A massive ad campaign has just gone live, urging senators to side with traditional banks over crypto consumers. The target? The stablecoin loophole. Lobbying groups like the Independent Community Bankers of America, ICBA, are claiming that stablecoins could drain $6 trillion from the banking system. They argue that this would crush Main Street, hurting farmers and small businesses. In reality, the threat is the yield. Coinbase CEO Brian Armstrong is being branded enemy number one on Wall Street because he wants to give the 5% yield earned on stablecoin reserves back to the consumers. Traditional banks rely on taking your deposits, earning that 5% for themselves, and giving you nothing in return. If Coinbase succeeds in bypassing the middleman, the traditional banking model becomes obsolete. This battle over the Clarity Act and market structure is a primary reason for the regulatory FUD currently suppressing prices. Jacques Fort. When we zoom out to the monthly Bitcoin chart, the technicals are grim. We are currently in the fourth straight month of downward price action. This hasn't happened since the brutal bear market of 2018. The institutional pain point. The price has officially dipped below the average cost basis for the spot Bitcoin ETFs. This means that the massive wave of Wall Street institutions and their clients who entered the market last year are now officially underwater. Furthermore, we have hit the cost basis for MicroStrategy. For years, Saylor's buys were in the green. Now, the market is testing the resolve of the biggest diamond hands in history. The CME gap, the only hope? However, there is one technical anomaly that suggests a reversal is coming. There is a massive CME gap at $84,000. In the futures market, these gaps are created when Bitcoin moves during the weekend while the regulated exchange is closed. Over the last 6 months, 95% of these gaps have been filled within 7 days. While the short-term trend is short, the magnetic pull toward $84,000 remains the primary target for a relief rally. We are living through a perfect storm. A $300 billion liquidity drain, the first bank failure of the year, a government shutdown, and a full-scale lobbying war against stablecoins. It is easy to look at the screen and see red, but the law of Michael Saylor reminds us of the core thesis. The market is currently trying to press the buttons of human fear, but Bitcoin, much like the description of Saylor in the Epstein files, has no ego, no vanity, and no social instincts. It is a protocol that ignores the drama of Washington and the greed of community bankers. Whether the TGA drains tomorrow or next month, the hardest money ever created is simply waiting for the liquidity to return. The $84,000 gap is waiting. The question is, do you have the social awkwardness to ignore the noise and wait for the fill? This video is for information and educational purpose only and is not a financial advice. We truly hope you enjoyed this video and learned something valuable. Please like, subscribe, and tap the bell icon to stay updated with our latest content. Your support helps us grow and continue creating useful videos. Share it with others so they can benefit as well. Like, subscribe.